Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Paris Rapeseed, Winnipeg Canola, and Malaysian palm oil.
Hello and welcome. Before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production or recognition of any of the patterns, levels, analysis or on any related items on these my charts. This was all my own original work, as I think you deserve to have that. So with that, Paris Rapeseed. Since the low in mid-March, where we saw the fall ending with a hammer pattern, we've seen a V-bottom, followed overall by prices for the most part very gradually moving higher in what I initially thought might be a possible ascending triangle pattern, but which became an ascending wedge pattern. The lower trend line for both is the bright red mid-March to date uptrend, currently at 482 even. And initially I chose not to draw a new trend line on the top side, but instead rely on two previously highlighted features. The first is the fairly flatlining gold long moving average, currently at 496 3/4. or the dark blue neckline extension, currently at 498, to the April to August 2024 head and shoulders top. Now, we've had attempts higher over both of these, over most of mid-May. But we finally had a really concerted attempt higher 7 weeks ago. Though this initially looked good, and the subsequent gapping changeover move lower put the market back down within the body of the ascending wedge pattern once again. The fall was slowed by the bright green, very shallow neckline extension, currently at 481 1/4 of the August to September 2024 head and shoulders top. A neckline that had acted as a resistance in April and a sort of support in the change from May into June. And interestingly, we saw last week, yesterday again, and today, it also acting as a support. Not necessarily that good today, but acting as a support. Further support was and still is from the mauve medium moving average at 481 3/4, and I suppose in the past the green short medium moving average, currently 487 1/2. Though this is now capping the market last week. Between the bright green neckline extension and the 50% Fibonacci line of the May 23 to January 25 move, down at 467 1/4. Now quite a wide support zone, but still there. So overall we are once again in the immediate future, supported by this congestion zone below and capped again on the wide by the gold long moving average or above. Nevertheless, 4 weeks ago I decided to lay out some potential targets topside for this ascending wedge pattern. Though, as I said 3 weeks ago, and I quote, I freely admit I have doubts about them and would consider some immediate retirement should prices drop down below that congestion zone below. Thus, a primary target X is up in the 521 even area, just above the congestion overhead, that is between 514 to 519 1/2, which capped prices 6 weeks ago, plus a secondary harder to reach target X1 up in the 537 even area. Now this latter one looks very hard to achieve until you realize that we have limited overhead resistances past the congestion overhead between 514 to 519 1/2, which capped the rise 5 weeks ago. Looking beyond that, well, it looks fairly quiet and empty right now, but first we have to get up there to see if this is true. And so far, that is something the market has not managed to do. Prices have instead started to test the downside. Closing below the bright red lower trend line of the ascending wedge pattern for the first time 3 weeks ago. However, that was a bit early for downside targets, but bearing in mind that the topside targets are already out there, a point that now seems very, very moot. So 3 weeks ago, I risked laying out some targets below to balance the topside ones, the upside ones. Thus, a primary target X2 is down at 462 even, underneath the 50% Fibonacci of the May 23 to January 25 move of 467 1/4, but just above the late April low at 461. We also have a secondary, harder to reach, much harder to reach, target X3 and that's down at 433.5, a target that seems very out of reach right now. One final thing, and this may become a thing, a bit of a thing going forward, though it's early days right now. I last week drew a mid-March to mid-July bullish shift pitchfork, which I highlighted this week in purple. It is very tentative, but we're still within it, and it's starting to look good as we sit in between the lower time below, currently at 478 and 3/4, and the middle time above, currently 506 and 3/4. I'm quite happy to finish that to a shallower bullish shift pitchfork for the same move, but I'll do that maybe next time. Just keep an eye wary on this, and it may become interesting, or it may become retired, or it may become morphed into a shallow bullish shift pitchfork for the same move, or, and this is something I noticed this week, part of it, the mid-June to date part, might become a possible bearish halfway hesitation, so caution. Winnipeg canola. So relatively little has happened here in relative terms since last week, such that this is going to be a fairly easy video commentary to dictate. So back in mid-May, we started to run into some serious overhead dynamic resistances, I hasten to add. Specifically a resistance I mentioned 13 weeks ago, and I quote, some generated congestion roughly between 723.70 to 735.20, plus a recent ascending wedge lower trendline extension, end of quote. Now, I also added to this list 11 weeks ago the neckline extension, which is highlighted in bright red, of the old August to October 2024 reverse head and shoulders continuation pattern. That's currently at 763.70. This one had been particularly good at capping the market as recently as 6 weeks ago and at the start of 5 weeks ago. The only reason I didn't mention that any earlier was I thought back then that the 723.70 to 735.20 congestion area overhead, well, that would have been enough. In the end, we had a gapping changeover lower 11 weeks ago, leading to what can best be described as a somewhat artificial weekly key reversal down. Prices have tempered on approach to the overhead 50% Fibonacci line of the July 23 to September 24 move at 700.5, before finally breaking higher mid-June and filling in the changeover gap. All this was achieved from the ammunition gathered in the earlier drop down as we entered into June, down to the previous mid-May low in the 664.10 zone, which is coincident with the November 2024 high and the interesting 38.2% Fibonacci line at 665.70 of the same July 23 to September 24 move that the 50% Fibonacci line above had capped prices on, plus the not insignificant rising green short medium moving average, currently at 701.10. So all these halted the decline at the turn from May into June. Now, as I said 7 weeks ago at the end of my commentary, and I quote, so what have we growing here as a pattern? Well, I'm not too sure, but if I was to hazard a very outside, really outside idea, then I would look at the action recently as a possible bearish cat's ears pattern, or less outrageously, maybe a double bottom, end of quote. Well, since then we have seen the formation of the easier double bottom pattern. This followed on higher to reach both the primary and secondary top side targets. But then 6 weeks ago, the market became capped once again by that previously mentioned bright red neckline, dropping back down in a stepping motion down to below the green short medium moving average, as well as the 50% Fibonacci line at 700.30, back to levels we saw in early June, just above a lesser Fibonacci line at 678.40 and a little above the mauve medium moving average, currently 678.70. We've since recovered, but as I said last week, and I quote, it still has left us all somewhat rudderless with a possible topping action, but no definitive pattern emerging as yet, end of quote. Now, this rudderlessness, is there such a word? Rudderlessness is why this week's commentary mirrors a lot of what I said last week. Anyway, I also said back then, and I quote, we might still form some other patterns such as a head and shoulders top, and I'll watch out for that, but for now I don't see any major pattern as yet. And for those who ask, no, I am not comfortable drawing fresh bullish andros or bullish shift pitchforks just yet, as it looks like unstable ground right now. Just watch out near term on the top side, the dark blue October to November 23 October to November 2023 neckline is currently at 725 even. It might still have a bit of a bite, end of quote. I would add to that, also watch out for the rising mauve medium moving average below, and that's currently at 678.80, as this is now entering the frame of the market. Bursa Malaysia crude palm oil. To start with, as I've done here for a number of weeks now, I'd like to look to the wide congestion area now overhead between 44.08 to 45.59. This is when I started a bit far away. This is when I started a bit further away, but it's been getting closer week by week. It was originally support, but is now resistance, and not only that, but longer term resistance. Next, there's the significant combination of the 38.2% Fibonacci line of the May 20 to March 23 move and the 50% Fibonacci line of the May 23 to December 24 moves, both very close at 42.74 together, capping the market this week, being joined recently and now separating away below the market by the declining mauve medium moving average, and that's currently at 41.36. This, interestingly, capped prices 3 weeks ago, this mauve medium moving average, and the start of 2 weeks ago, but gave way under bullish pressure late 2 weeks ago, and we can look at it now as support. We also have nearby the lesser Fibonacci line at 42.39, though this now doesn't seem to be that significant right away. This overall move higher all started with the drop down and subsequent build up from the testing and breaching of the interesting dark blue neckline extension below, and that's currently at 38.70, and that's at the small May to April 2024 reverse head and shoulders bottom. I said 13 weeks ago about this dark blue neckline, and I quote, "This is one to watch on the downside, as it's core of a large April to September 2024 congestion zone stretching from roughly 3750 up to 4100, end of quote. This dark blue neckline extension became a key support, then a resistance, and now an important congestion point, all at the same time. Importantly, it caused prices start to move higher, with what turned out to be, as I said 7 weeks ago, and I quote, a possible, if imperfect, bright red ascending triangle pattern formed over May to date. It is a small pattern, and I could regard the action as an attempted false break on the downside that so far has failed. False breaks, coming as they do so far along the triangle and so close to the tip, are not unexpected, and whilst I cannot as yet give definitive targets for either side, I can give an idea of the potentials involved. Thus, a true confirmed break higher over the bright red upper trend line will have a primary potential of plus 209 ringgits, with a secondary harder to reach potential of plus 298 ringgits, whilst a true confirmed break lower below the bright red lower trend line will have a primary potential of minus 131 ringgits, with a secondary harder to reach potential of minus 298 ringgits. End of quote. Since then, prices stabilized over the bright red upper trend line and leading with those earlier numbers to a primary target topside in the 41.90 area and a secondary harder to achieve target up in the 42.79 area. In many ways, these two target areas encapsulate the next area of congestion overhead. 3 weeks ago, the market reached up and opened over the primary target when it moved up over the mauve medium moving average. Late 2 weeks ago, prices went further and reached the secondary target at 42.79. All this action over since mid-May has led to the construction of a mid-May to date bull channel, currently 41.58 to 44.20. That utilizes the bright red breached but repaired lower trend line and a newly drawn and today also highlighted in bright red upper trend line. What is interesting about this upper trend line is that it crossed over the flatlining gold long moving average, currently 44.12, in the middle of this week. I said last week, and I quote, I would be very wary around that time, as we would see a significant move or even just volatility at that time, end of quote. Well, I'm sorry to say we didn't see much of any of that this week, and that is a little disappointing. So in the meantime, the market remains within the bright red bull channel. But we do have the flatlining gold long moving average now within the same bull channel, and that was mentioned earlier. Just remember to keep an eye on the gold long moving average when moving within the bull channel. There is one other feature I'd like you to discuss, and this came about because I was at the end of June speaking about it in a presentation at the Biofuels International Conference and Expo in Brussels, Belgium. It was and is to watch out for a key level from now until the end of this year. And that level is 35.99. It's a singular level, 35.99. So quite a way below the market. And if prices do push down below 35.99 before the end of this year, then we would have set up the conditions here in palm oil to make that rarest of patterns an annual key reversal. Please watch out for this, as it's important. I'll bring you more detail should we get down below there, even though I know we today are many hundreds of ringgits above it. Just please bear it in mind. We still have many months of this year to go.
Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.